In today's episode of Joe Knows Retirement, we're going to be talking about the myth that you may have heard before of should you defer your taxes into retirement because you'll be in a lower income tax bracket. And we hear that all the time. And I'm here to tell you that that is normally true. For most people, they will be in a lower tax bracket in retirement. And the reason why is because of the standard deduction. And so right now in 2025, the standard deduction for a married couple is about $31,500. And if you're older than 65, then your standard deduction for those who are married filing jointly due to the bonus deduction could be all the way up to almost $47,000 that you can write off tax-free. And so if all you do is have income up to that point, so if you are working and you make $31,000 and that's it, then you don't have to pay any taxes on that money. And so a lot of people, they get to retirement and they are in that category, but those are people without pensions. And the reason why is because, hey, if all they have is their Social Security income, well, Social Security may not be taxable to you. We'll talk about that in today's video. But also your investment withdrawals may be able to stay under that standard deduction. And so if that's the case, then you actually will be in a lower tax bracket in retirement. But like we talked about, if you have a pension, then you're going to have a guaranteed amount that's higher coming to you for the rest of your life. And we're going to break down in today's video that you may not be able to be in a lower tax bracket. You may only be in the same or higher in the future. And we're going to talk about how to plan for that in today's episode of Joe Knows Retirement. So stay tuned and let's have some fun here today.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So I know you've been told this before. I know while you're working in the accumulation phase, when you've been saving and you've been working hard and you've been that diligent saver, that Midwestern millionaire we always talk about on this channel, those who are hardworking, they're frugal, they're diligent savers. And so now that's gotten to a place where you now have financial freedom. You can do what you want, when you want, with who you want, as I always say. And now you have more freedom and flexibility from a planning standpoint. Now, that also means that you're likely going to have the biggest expense in your retirement is probably going to be taxes for you at this point, knowing that that guaranteed income from your pension puts you in a higher tax bracket. And also all these investments you've saved, especially if you've been that diligent saver, you've saved $1 million or more, who we talk about often on this channel, you're going to have larger required minimum distributions in the future. When you take withdrawals, that's going to be taxable on top of your pension and on top of your Social Security, now that you're likely be eligible for that due to the elimination of the windfall elimination provision and the GPO offset there. If you're probably familiar with those terms that just got thrown away, to now have more opportunity to get more income from your Social Security as well. And so when you look at all of this playing together, it can lead to more taxes in your retirement. So let's break this down a little bit further. And for you that are, maybe this is your first time to our channel, my name is Joe Schmitz. I'm the CEO and founder of Peak Retirement Planning. We're based in Columbus, Ohio, but serve clients all across the country. And this is an area we specialize in, is those with pensions. And I wrote a book called The 2% Club. So this is a book that is all about those who have a pension, which is less than 20% of people out there, and those who have $1 million or more saved, which is only less than 10% of people out there. When you combine those two percentages, you're left with 2%. And obviously the planning for these folks is more unique. We're not talking about the cookie cutter approaches that most fast food wealth management firms talk about, and you got to do this, you got to do that. That may not apply to you. And so that's what we're going to break down in today's video. So the first thing I want to do is understand the value of your pension, right? Again, 80% of people don't have a pension. So if you get $50,000 that come to you every single year from your pension, and we've seen people with higher than this, it's not outside the realm of possibility. We see people with six-figure pensions where it's paying out $100,000 a year. Let's say though it's $50,000 a year. Well, if you live for 20 more years, then that's $1 million that is being paid out to you, and that's expected. You're not having to worry about any market turbulence or volatility. You're just getting that no matter what economic cycle the situation is. You're not going to have to plan for that money coming in. It's just there. So a pension is an awesome opportunity to have. So I know it's going to sound like, we're talking badly about the pension because it's going to cause more in taxes, but remember, the higher income, you are going to have more problems, but they are good problems to have. These are good problems to solve. These are, exciting problems that many people don't have to deal with. And so we will definitely deal with these problems knowing that it can come and lead to more opportunities for our retirement. And so because you have this extra, we'll call it $1 million asset, right? If you have a $50,000 pension, as we just talked through, well, that's going to lead to you likely having more of an issue in retirement. So that's one of the first things that we got to consider is a pension. But as we always talk about is the investments, right? And so a lot of people who have $1 million or more saved in their investments are going to end up in the same or higher tax bracket in retirement, even if they don't have a pension. And one of the big reasons why is because every withdrawal from that is going to be taxable. And more importantly, when they reach required minimum distribution age, which is either 73 or 75, depending on when they were born, this is when the government forces you to take out money from those tax deferred investments. And as I always say, I don't think it's a good thing when the government forces us to do something, but this can also drive your income higher. And what happens with RMDs over your retirement is it grows and grows and grows and grows. So you maybe only have to take out 4% up front, and then it goes to 5%, 6%, 7%. But also, if your investment is growing over time as well as we expect it to be, not only is your withdrawal rate increasing, but also the amount you're withdrawing is increasing as well. And so that's going to lead to what we call retirement tax time bomb, where you're going to have and go up incomes over time potentially, up tax brackets potentially because of this increase. And so, that's where the pension, now you have this RMD, and then also since 1985, Social Security has been taxable. Now, this conversation gets a little tricky. Is Social Security taxable or if it's not? For a majority of people, Social Security will not be taxable, right? You heard Trump announce this with the one big beautiful bill. Social Security will be tax-free. Now, they weren't able to get that completed, but they were able to make some adjustments like the bonus deduction, where now you can each as a married couple, write off an additional $6,000 each if you're over 65 on top of the standard deduction. And so like we talk about, that usually gets you up to about a $47,000 total deduction. And again, most people, will have Social Security tax-free because of that. Most people will not have to pay as much taxes in retirement because of things like that ongoing. And so people with pension, though, they may be phased out of that right away, right? If you have a $50,000 pension, you're automatically phased out of that. You're now forcing Social Security to become taxable. And so Social Security, the way I explain it, it's based on provisional income. And so if your income is lower, so from here to here, well, you're not going to have to worry about your Social Security becoming taxable. So if you get $3,000 a month check from Social Security, all of that's in your pocket. You're not going to have to worry about giving up anything to Uncle Sam. Now, with most of our clients who have pension, million plus, we see that they often reach that point where 85% of their Social Security is counted as income. Now, that doesn't mean it's counted as an 85% tax rate. It's just 85% of it is taxable at your income rate. So 12%, 22%, and so on. And so that's how this Social Security taxation works. So you with a pension can probably realize you're going to have some sort of your Social Security taxable. The question becomes of how much. Can you get it down lower? So not 85%, but maybe only 50% of it taxable. And for some of our clients, that's a realistic opportunity. Some of our clients, maybe they have a $100,000 pension a year. Well, it may not be realistic for them to be able to keep Social Security tax-free or even less taxable. They may automatically force that to be 85% taxable. And so that case, they've got their pension, 85% of their Social Security, and then they've got those RMDs or with investment withdrawals that they make during their retirement. When you factor in all that, you typically see that they're going to be in the same or higher tax bracket in retirement. And let's just go through a real life case example to show you an idea. So we had a client, their pension was $50,000, just like the example we're using here. Their Social Security was also, they were a joint couple, so their Social Security was $60,000 was what it was for them, after all the spousal benefit and everything that they got with it. And so when you factor in that, they had $110,000 of just guaranteed income. So, they wake up and that money's in their mailbox no matter what. They don't have to work anymore. They don't have to do anything extra. They don't have to think about it. It just comes in every single year, which is an awesome opportunity to have. And so for most people, that may be enough for them to live on. They may not need to take anything from their investments at that point. And so maybe they don't until they reach the age of 73 or 75 for required minimum distribution. And then they have to take out, let's say they have $1 million, they have to take out $40,000 on top of that. And so now their total income is going to be about $150,000. This couple specifically never made $150,000 a year. They're that Midwestern millionaire. They never made millions of dollars a year. They never made significant income per year, but they were diligent. They were hardworking. They were frugal. They did the right things over time to get them in a place where they could have this financial freedom. And so you can see very quickly how your income can really go up even if you just have $1 million and a $50,000 pension, you can see that you're likely going to be in the same or higher tax bracket in retirement. And more importantly, you're going to be outside of those lower tax brackets. And so lower tax brackets, we think of, the standard deduction, the 10% and the 12% currently today. Based on that, you can look at about $130,000, be in that range that if you have income up to $130,000, you'll stay in that 12% bracket. And so that's really where you have to evaluate and see, where are you at now? Where will you be at in the future with all of those income sources coming in from your investments and pensions, Social Security? And maybe you do plan on continuing to work, so you have to factor in that as well. Maybe if you plan on working part-time or whatever that may be for you. Or maybe you have an inherited IRA that you have to take out over 10 years, or maybe it's a stretch IRA that you have to take out over years. So you have to factor all that income in. Also, any capital gains income. Maybe you have a brokerage account that's spitting off capital gains. There's a lot of planning you can do around that as well. Maybe look at planning against those phantom gains if you have mutual funds there, so you can have more control. Maybe look at things like individual stocks or ETFs or index funds, so you can have more control over that. Also look at things like tax loss harvesting, so you can write off your losses against your income and save money there. That's something we do with all of our clients who have those brokerage accounts. And, we look to do daily scans of that so we can be really tax efficient there and not miss opportunities. But when you look at all of those income sources playing together, or just look at your tax return, that's going to tell you where you sit. And that's going to tell you, also if you do a projection for what your tax return will look like, 10 years from now, as an example, that will also help you understand the decisions you need to make today to help put that in a better situation in the future. So, as you hear this myth of you'll be in a lower tax bracket in retirement, really have that lens to say, is this for me or is this not? And the only way you'll know that is by just running your numbers. Run your numbers today and run your numbers for what you expect your income to be at that age 73 or 75 to give you a really good example of what that could look like. And the other thing to think about this too is think about it past your lifetime. So we get a lot of people that reach out to us from this YouTube channel who they're married couples, and one may be more involved than the other. And so a lot of them work with us because they're worried about, if one spouse passes, making sure that other spouse is good to go. And they're also worried from a standpoint of, if one spouse passes, from a technical side, there's some disadvantages. One, you lose one of the Social Securities. Two is you may lose some of the pension depending on what survivorship option you elected there. And then the third thing is your taxes go from married filing jointly to single. And so all of these differences is what we call the widow's penalty. And this is a big thing to plan for if you are a married couple. And this is basically going to increase the taxes by nearly double the amount when one spouse passes. And so this is something that you can also think of, this phrase of you'll be in a lower tax bracket in retirement. Well, regardless if you have a pension or not, if one spouse passes, you're probably not going to be in a lower tax bracket because of the single tax brackets being less advantageous than the married filing jointly tax rates. You get less of a standard deduction. You get lower, the tax brackets start to creep up sooner, so you're going to have to pay more in taxes. The Medicare tiers that you're going to have to pay for Medicare premiums is going to increase as well. And that's another example for the people watching that you'll likely not be in a lower tax bracket. Think of it not only from a tax bracket, but an all-in tax rate scenario. So we talk about Social Security tax, we talked about capital gains. Capital gains could be 0% for the capital gains if your income is low enough, right? So if your income's about under 130,000, like we talked about, that 12% bracket, well, if your capital gains, if you're in that 12% bracket, you may not have to pay any tax on your capital gains. But if you're over that, now you have to pay up to 15% or even 20%. Most of our clients are in that 15% category that they're going to have to pay an additional capital gains. But in addition to that is these Medicare premiums that we're talking about now, and that's going to be based on your income. And so the tiers for a married couple is about $200,000, for singles about $100,000. So you can see in this widow's penalty example, you're more likely going to be over that tier if you're single than if you're married. And we get a lot of clients that are worried about these tiers over time with that pension, Social Security, and their investments on top of that. And you just have to remember that, again, these are great problems to have, but we do need to make sure we're being proactive and just maximizing our situation. And so if you really want to even be thinking beyond your retirement and your spouse's retirement, maybe you have some children you want to leave this wealth to. Well, we know the new rules so that they now have to take this out over 10 years. And so, is their tax bracket going to be lower than yours? And I really want you to think hard about that, because if you have a pension, maybe your kids could be in a lower tax bracket. And if that's the case, hey, maybe we don't have to be as aggressive with our tax planning to, have things in a Roth or things like that to make sure that, hey, let's make sure that we're being strategic of what their tax rate is expected to be in the future. Now, most of our clients are worried that their kids are going to be in the same or higher tax bracket than them, because that 10-year withdrawal is going to cause them to take out large amounts on top of their current income when they're working at probably their peak earning years. And we also don't know what tax rates will be in the future, which most people suggest will be higher. And so this is also something to look at of, hey, will you not only be in a lower tax bracket bracket during your retirement, during the widow's penalty of your spouse's retirement if one of you pass, but also for your kids if you want to leave a legacy. Now, if you're the type of person that says, I want to spend every last dollar, I want that last dollar to bounce back, that last check to bounce back, well, then maybe that's not important to you, but it's even more of a lens to look at it for you of what you should be doing during your retirement. And so something we look at with our clients that are in this scenario that we've talked about so far in the video is look at strategies like, Roth conversion. We've mentioned some other tax planning strategies to consider, but this is a really popular one for people in this boat, especially with the tax rates being lower, as I just mentioned. And so this is a way that you can move all these tax deferred dollars you have, or a portion of them is what we typically recommend, over to a Roth where you pay the taxes now at potentially lower rates when your income could be lower before RMDs start, before you maybe take Social Security, before your, all these income sources play together. And then all that growth moving forward is tax-free so that when you do get your later years of retirement, you may not end up being in a higher tax bracket because you can take from the Roth, which is tax-free. You'll have less in your tax deferred, so your R&Ds won't be as big. And so this could be a really big planning opportunity for a lot of clients we see, especially right now, knowing that the tax brackets are pretty wide right now. And so, for example, the 24% bracket, which a lot of our clients see as a very reasonable tax rate, knowing that in the future that could likely be higher for them. But, that goes up to about $400 and almost $30,000. So if you have up to $400, plus $1,000, you could still stay in the 24% bracket. So maybe your income, maybe you're still working, maybe it's only $200,000 or $100,000. You still have quite a bit of room to use up these relatively low tax brackets right now to shift some of this over. And most people we see when they first come to us have all their money in tax deferred, very little in tax free. And so they want to look to have more of a balance over time. And now could be a really opportunistic time to look at that. So something to really look into, and doing this will allow you to be more tax efficient in your income planning in retirement. And so if you need to take income from your investments to, make sure you have enough income on top of your pension, Social Security, now you'll have that flexibility. You can choose, do I want to take from tax deferred or tax free? Maybe tax rates are really high, we'll take from tax free. If tax rates are really low, we'll take from tax deferred. And so this gives you the flexibility and control, right? You're not worried about Uncle Sam telling you what's going to happen in retirement when you take out money or what tax rate he's going to choose for you to pay, because we don't have the control of the tax code. Tax code's written in pencil. So these are all practical strategies we can look at to really lead to a lot of success over retirement. So obviously those are some key things to think about with this topic, and we hear it often, but I'd love your take on this. Do you think that you'll be in a lower tax bracket? Because we do see people with pensions who end up in a lower tax bracket in retirement, but typically those are people with smaller pensions, or maybe they have smaller amounts saved. But I'd love your interaction, your comments. What do you think of today's video? Do you agree with this concept? Why do you think people say it so often, outside of the thoughts that I mentioned, right? We talked about how most people will be in a lower tax bracket, but that may not be the case for the 2% club with pensions and $1 million plus saved. So hopefully this content was helpful. If you're really looking for tax planning help or more guidance on this type of planning, I'll go ahead and have our team put up 2 videos here for you to look out further for, so that you can learn more on this topic to make sure you're best informed and engaged as you learn this retirement moving forward. And go ahead and subscribe to our channel so you can keep up-to-date videos coming your way. We post videos every single week on this topic of pensions and those who have been diligent savers. So enjoy the rest of your day, and we'll see you on the next video of Joe Knows Retirement.